Welcome to LR Reports. This episode is based on institutional research published by a leading global financial firm. We focus on the core investment thesis, key assumptions, and material risks outlined in the original report.
Welcome back. Today, we're doing a deep dive into a really critical piece of research on Asian equity allocations for the year ahead. We're going to approach this just as if we were on a buy-side desk, really distilling the analysis and the logic here for the informed investor.
That's right. And to be clear on our source material, we are working exclusively from a Jefferies Thematic Research report. It's titled Asia Outlook 2026, Our Best Ideas, and it was published on December 10th, 2025.
Okay, let's get right into it. The report starts by framing Asia as a differentiated opportunity. Before we get into the 2026 drivers, what's that core structural argument?
Well, it really comes down to a major disparity between economic weight and what you see in the indexes.
Right.
So emerging market Asia contributes about 30% of global GDP, and it's driving something like 60% of real global growth. That's the engine.
A huge engine. But how does that translate into the investment universe, into the global indices?
That's the thing. It doesn't. Not yet. If you look at the MSCI, ACWI, EM Asia is only about 9% of the total weight.
So 30% of GDP for 9% of the index.
Exactly. That imbalance is their entire starting premise. It suggests there's just a substantial runway for index weight to expand as capital flows eventually start to normalize.
Okay, so that's the long-term structural tailwind. But tactically, 2025 was very much about re-rating, right? Finding those cheap value stocks.
It was. And that means the deep value argument has, diminished quite a bit.
So what's taking its place for 2026? What are the key growth drivers now?
The focus is definitely shifting. It's moving towards more structural growth themes. We're talking about AI adoption, new age commodities for the energy transition, high-tech manufacturing, and then also that targeted infrastructure spend that supports the consumer.
And crucially, the earnings growth has to be there to support that pivot. The report seems to be modeling a pretty significant acceleration.
It is, yeah. After about 8% growth in 2025, which was fine, the consensus for MSCI APXJ EPS growth is expected to accelerate to 18% in 2026. That acceleration is really the key.
18%. And you pair that with the valuation discount you mentioned earlier. What does that combination really signal?
It suggests the market isn't fully pricing this in. MSCI APXJ is still trading at a significant discount to developed markets. So even if the re-rating phase is over, that earnings growth alone should be enough to drive returns, assuming, of course, the macro picture holds up.
Right, let's talk about that. Before we drill down into countries, we have to understand the U.S. macro assumptions here. What's the Jefferies base case?
Their base case is pretty clear.
Right.
A U.S. GDP growth slowdown, and with that, a rise in unemployment. On inflation, they see it easing, but, and this is important, staying above that 2% Fed target. It's not going to be a smooth landing.
And how does that translate to monetary policy? For Asia, it's all about the U.S. dollar and funding costs.
The policy outlook is very front-loaded. They're expecting 1 to 2 Fed rate cuts in the first quarter of 2026, maybe another 1 or 2 later in the year.
And the dollar.
That's the crucial part. They expect the dollar to weaken in Q1 before it stabilizes. A weaker dollar, as you know, is generally a tailwind for emerging markets. They also see oil staying pretty stable in the $55 to $60 range.
Okay, so that macro setup feeds right into their regional strategy. How are they ranking the countries? Where's the conviction?
The rankings are very specific. It's not a broad regional call. They've got Korea, Indonesia, China, and Japan rated as overweight.
OWT, okay.
Then you have big group in neutral, Hong Kong, India, Singapore, Australia, the Philippines. And finally, underweight is Malaysia, Taiwan, and Thailand. The key takeaway is that they're prioritizing domestic stories.
Let's dig into those high conviction calls.
Yeah.
Japan is an overweight, and it's probably one of the most interesting stories globally. What's the take?
The view on Japan is that it's finally breaking its old cyclical pattern, that mean reversion dynamic. They're saying this time is structurally different. 3 things. 1, the Tokyo Stock Exchange reforms are actually forcing change. 2, you have sticky inflation, which is giving companies pricing power. And 3, there are some pro-growth fiscal tailwinds.
We've heard the Japan reform story before. Why should an investor believe this forecast for, 13% TOPIX upside?
Because it's almost entirely earnings-driven. They expect 90% of that return to come from earnings growth, not just multiple expansion. Those TSE reforms are genuinely forcing management to focus on ROE in a way they haven't had to before.
Let's talk currency. That's always the tricky part with Japan. What's the yen outlook?
They see it appreciating in the near term, strengthening towards 145 to the dollar. After that, it should settle into a range, maybe 145 to 150.
And the report notes something unusual happening with its historical correlations.
Yes, and this is fascinating. The historical link between the yen and the U.S.-Japan yield spread has basically broken down.
That's a huge deal. They usually move in lockstep. What's driving that decoupling?
It seems to be that even as the Bank of Japan tries to normalize, the sheer scale of global capital flows is just capping the yen's upside. So the currency might not be the traditional head it once was.
So where do you position for this structural change in Japan? What sectors do they like?
They're favoring sectors that align with these big themes. So industrial electronics, semiconductor production equipment, SBEIT services, gaming, healthcare, and defense.
Okay, let's move south to India. It's rated neutral, which might surprise some people given the long-term growth story. Why the caution?
Right. They do acknowledge that India's underperformance from 2025 is probably over. The earnings downgrade cycle seems to have ended. They just saw the first month of earnings upgrades in over a year. And they're still projecting robust EPS growth of 15.9% for FY27.
So if earnings are turning and growth is strong, why stay neutral?
It really comes down to valuation and a lack of, big market-wide catalysts in the near term. The strategy has to be very selective. They're overweight banks, for instance, where valuations look attractive. Also autos, power, telecom, and property. But they're cautious on areas like consumer and IT.
Now for the big one, China. Jefferies is maintaining an overweight, which feels a bit contrarian given all the noise. How solid is that call?
It's a conviction call, for sure. And it's supported by positioning and fundamentals. First, the overcrowding concerns are actually easing. A lot of EM investors are still underweight China.
Okay.
And the thesis rests on two pillars: strong earnings momentum in certain sectors and very attractive dividend yield opportunities in others. They see about 15% upside, driven mostly by those earnings.
But hold on, with all the property sector worries still out there, how resilient can that earnings story really be?
They argue the earnings story is decoupling from the distressed parts of the economy. The 2026 view is driven by 5 core themes: high-growth tech and manufacturing, what they call secular upgrades, sustainable yield, potential HK IPOs, and a focus on these RESC stars.
Let's pivot to a specific industry they mention, lithium batteries. The report flags a pretty big shift in the growth narrative there.
Absolutely. The main growth driver is moving away from just EVs and shifting globally towards battery energy storage systems, or BANS, grid-scale storage. They're forecasting ESS shipments to grow over 40% in 2026.
And that has knock-on effects for other industries.
It does. It should help the solar industry, which has been really competitive. They expect solar to bottom out in the first quarter of 26, partly supported by this huge demand for storage.
Okay, and what about AI in China? Compute power has been a major constraint. Is that picture improving?
The report suggests it should improve significantly in 2026. This is partly due to a ramp-up in domestic capacity. They mention Huawei's GPU yields improving, for example. Also, cloud competition is easing up a bit. That
brings us to investment style. If the big re-rating phase for Asia is over, what style does Jefferies favor for 2026?
The very clear pivot away from deep value. The focus now is firmly on JARP growth at a reasonable price.
Why that shift?
Because with the re-rating done, earning support becomes the only reliable driver of returns. You have to be focused on both growth and the price you're paying for it.
So how does that JARP philosophy translate into their best ideas portfolio? You mentioned a barbell approach and a term we should unpack, ROIC stars.
Right. The barbell combines quality and valuation. The core of the portfolio is these ROIC stars, which they define as companies with high and, importantly, rising return on invested capital. It's their key indicator of a company's competitive moat.
For listeners who might be less familiar, can you explain why a high and rising ROIC signals a strong moat?
Sure. Think of ROIC as a measure of how efficiently a company uses its capital. A high ROIC means it's generating great returns. A rising ROIC tells you that management is allocating new capital effectively and that reinvestment is making the business even more profitable over time. That strengthens its competitive position.
So you have that quality bucket. What's on the other side of the barbell?
That quality is balanced with high-conviction GARP stocks. So strong earnings momentum, attractive valuation, and then also what they call sustainable yield stocks. These are companies with high dividends that are backed by solid free cash flow.
And are there specific metrics for those GARPA and yield baskets?
Yes, it's quite quantitative. For GARP, they're looking for strong EPS growth, say over 10% in China, with a PE to growth ratio of less than 1.5. For the yield basket, it's a forward dividend yield over 3%, but it has to be backed by free cash flow yield and a good track record.
Okay, we've covered the opportunity and the strategy. Now for the headwinds. What are the main macro risks that could derail this outlook?
They highlight three big ones. First, a potential U.S. recession. That's the primary risk. A deep slowdown in the U.S. would obviously challenge the earnings assumptions across Asia.
And the second risk is the AI bubble.
Exactly. The risk of a reality check, as they put it. That's when the market starts to seriously question the return on all this massive AI capital spending. They think that could happen sooner than people expect, maybe by the end of the first half of 2026.
And the third risk, which is almost a constant in Asia, geopolitics.
Geopolitics, right.
Yeah.
And they give a very specific example of how it can have an immediate impact. They mentioned the China travel warning related to some of the Japanese PM's remarks on Taiwan, which instantly hit Japanese tourism stocks. It shows how targeted the impact can be.
And were there any other regional specific risks that fed into some of their ratings?
There were. In Australia, for instance, they note the banks are facing tougher competition for deposits, which is pressuring their margins. And in Thailand, the slow pace of domestic reforms is a key reason for its underweight rating. So we pull all this together. What's the final takeaway for an investor looking at Asia in 2026? I think the conclusion is that returns are going to be driven by the E in PE, the earnings, not by multiple re-rating. So we should expect a more gradual, sustainable pace of performance. It's a phase of consolidation, really.
That makes a lot of sense. A shift from chasing cheap headlines to focusing on execution. And that brings us to our final provocative thought for you, the listener. The report notes that an increasing share of China's exports are going to the global south, to ASEAN, Africa, Latin America, not the G7. So if that trend continues and intra-emerging market trade keeps rising, what are the long-term implications for the traditional global supply chains that were all built around the West? It suggests a fundamental reshaping could be happening much faster than the indexes reflect. Something to think about.
You have been listening to LR Reports. This content is for informational purposes only and does not constitute investment advice.